How do international markets interact with the U.S. market? Let's cash in.
Finance for the everyday millennial. Hard charging solutions. We provide an accelerant in the journey towards financial independence.
Welcome back to RINO INVEST, the financial library for young professionals. The news is full of stories about economic turmoil in China, but how will that affect us here in the United States? Today, I'll take you through exactly how foreign markets interact with the U.S. market. But before we dive in, if you want to get a handle on your personal finances, open an account with RINO INVEST today. By opening a Club RINO Plus account, you will have access to a wealth of resources for financial success. From network trackers, checklists, handouts, a reading list, courses, an educational portal, and a forum to speak with other RINOs. Go down to the description of this video and click on the Open an Account link. Also, please subscribe to the channel if you haven't done so. It really helps us continue to deliver awesome content like this. All right, national economies have been dependent on foreign economies for a long time. One of the most famous historical examples is the Silk Road, a network of trade routes that transported luxury goods to Europe from the 2nd century BCE until the 15th century. Since that time, global economies have only become more intertwined. Free trade and trade liberalization have been increasingly the norm since the 1700s. Now, countries don't simply trade with one another. Instead, foreign economic dependencies run deep. From government dependencies on foreign credit to foreign investment to vast and complex supply chains. While these relationships can increase productivity and economic growth, the downside to these dependencies is that they leave the U.S. market more exposed to slowdowns in major foreign economies. One such economy is China. Recently, the combination of zero COVID policies and a property crash have battered the Chinese economy, unlike the U.S., where interest rates are rising to battle inflation. China has cut rates to try to spur demand in the wake of a real estate crash and their zero COVID policy. If you want to learn more about rising interest rates, click the link you see on your screen now. The Chinese real estate crash has been so large that it's even forced one of the country's largest builders to the edge of bankruptcy. This comes at a potentially poor time for other global economies as they are slowing in the wake of high inflation and energy price spikes from the war in Ukraine. After the 2008 global financial crisis, China's rapidly expanding economy and a huge stimulus unleashed by the Beijing government helped Western countries recover faster from the financial crisis. The weakness of Chinese demand means that won't happen this time around. Instead, China will be a drag on the global growth. Though, this may also mean that China cools inflation globally. If you want to learn more about inflation and how to combat it, click the link you see on your screen now. Like other major global economies, this could have serious ramifications for the U.S. market, businesses, and investors. To see why, let's look at how much the U.S. economy depends on China. A large part of the relationship between the U.S. and China is centered on trade, with the two countries having been each other's major trading partner for years. The relationship is an uneven one. The U.S. imports way more goods from China than it exports to China, but the reverse happens with services, where China imports much more than it exports to the U.S. Recent trade deals have seen an emphasis on having China agree to import more goods from the U.S. Beyond direct trade, the U.S. and China are also economically dependent on one another due to rising supply chain linkages. Supply chains are complex networks of companies that work together to provide the raw materials, intermediate parts, and expertise needed to produce a final product or service. Some American manufacturers, particularly producers of textiles, electronics, basic metals, and machinery, are especially reliant on China for intermediate inputs. On the other hand, due to recent trade tensions, investment flows between the countries have cratered. Given our foreign economic dependency on China, what is this likely to mean for the U.S.? First off, while China may export disinflation to the rest of the world, our supply chain interdependency may mean that we won't get this benefit. Instead, the slowdown in Chinese manufacturing could put even more upward pressure on prices here in the U.S. All while consumers and companies are already dealing with the return of high inflation and a recession potentially on the horizon. China also remains a significant foreign market for many U.S. goods and services. A slower Chinese economy could mean a decline in certain U.S. sectors like cars, electrical machinery, and medical equipment. This will hurt businesses and workers that rely on these exports to China. Because Chinese property developers hold small amounts of overseas debt, most economists don't think the global economy is facing the same sort of global financial crisis that we saw in 2008. Instead, the size of China's economy and the economic dependencies we've built mean that it is more likely that slow Chinese growth will simply be a drag on a U.S. economy that is already on an uneasy footing. Subscribe to the show to see more of our content and click the bell icon to receive a notification when a new video is published. Thank you for watching, and until next time, this is Cassian reminding you to seek real education, invest in performing assets, get rid of bad debt, and engage in oversight of those assets.